Welcome to Global Insights with me, Punita Kumar Sinha. This week, we continue our focus on the end of QE and understand its impact across asset classes. There has been much debate about how easy money has found its way into several asset classes, thereby increasing the risk of asset price bubbles, be it gold, equities, or bonds. All asset classes have given high annualized returns over the last 5 years. But with QE withdrawals slated for the end of this year, markets are nervous. Will there be more unwinding pressure in global markets? Sriram Iyer has more on that.
Gold prices have declined a lot since their heydays of 2012, but are still up 25% compared to 5 years ago. Global equity markets have gained significantly since the crash of 2008. Nasdaq has nearly doubled. Other indices on Wall Street are up anywhere between 60 and 72%. India, with all its macroeconomic woes in the last few years, the Nifty has gained over 50%. Freshly minted money from various central banks, particularly the US Federal Reserve, have fueled a rally across asset classes. But now that the Fed is ready to stop the steroids, can global markets hold their own? As the US Federal Reserve nears the end of its bond buying program, equity markets across the world are in a state of flux, down up to 9% in September alone. The volatility on Wall Street is at its highest since the winter of 2012. Fear of sluggish demand have pounded oil prices, and investors are moving their money to safer bets like government bonds. The dollar is getting stronger by the day, and most emerging markets are a nervous lot. Jury is still out on the health of the US economy, but Europe is most certainly still on a ventilator. And with the Federal Reserve hinting at a rate hike next year, the signs are ominous.
As we saw, the bets on riskier assets seem to be receding as the market braces itself for tighter liquidity. Gold, dollar, and US Treasuries have been the preferred bets. EMs barring India have been weak all of September, while Europe has fallen the most. To discuss more on the future of various asset classes, we have with us Russell Napier, consulting strategist, CLSA, and Jerry Webman, chief economist, Oppenheimer Funds. Welcome, gentlemen. Russell, let me start with you. Is the full withdrawal of QE going to be a non-event, or will it lead to a crash?
The full withdrawal of QE is something that's been well telegraphed. Everybody knows it's coming. That doesn't make it a non-event. I think we've seen in the past that when QE is being withdrawn, we knew it was going to happen, and yet there were reactions in the marketplace. The interesting reaction in the marketplace last time were actually the bond yields went down when the American government stopped buying treasuries. In other words, the impacts or the assumed impacts on the economy more than outweighed the direct impact on the treasury market from central bank buying. So I think it's not a non-event. The key event, I think, will be the dollar, and that is what's already developing in the markets. We could see a sharp spike in the dollar when this finally happens, and that will have huge implications across the planet.
And Jerry, what is your view? How will the financial markets react to the end of QE?
Well, we've certainly gotten plenty of warning about it, and sometimes markets react in ways that surprise us. But after the initial so-called taper tantrum in May of 2013, the markets have actually absorbed the reduction in quantitative easing in a pretty smooth, well-anticipated way. I think markets have absorbed it. We've known what to do. The Fed has been quite clear about what they expected. And we'll talk about other central banks, other developed market central banks that are actually ramping up their balance sheet building. So I think so far so good.
I hear you, Jerry, but do you think the world post-QE would not be much different than the world with QE all these years?
Well, of course, we'll always have surprises, but the reason that I think the financial markets may look the same, even though the causes may be different, is that the U.S. economy actually is in pretty good shape. And the U.S. economy, it's still, whatever changes we've gone through, is still by far the largest economy in the world. It will be important for what other economies do. And the U.S. economy, for some time to come, actually looks to be on pretty solid footing. So I think the financial markets might look quite similar, even though the reasons for them doing pretty well are different from what they've been over the last couple of years.
So you think investors are banking more on central banks to decide on asset allocation rather than fundamentals?
There's a very nuanced question. What central banks are doing, particularly in Europe, Japan, the US, are very important for the global economy. But I think there's a lot too much talking about it because actually they've made their intentions, plans, and what they're watching for as clear as it's possible for them to make it. Sometimes I think, in fact, they make it too clear and give us some precision where we don't really know what's happening. But in fact, I think investors should be focusing more on the fundamentals of the economies they're looking to invest in, or if they're credit market or equity market investors should be looking more closely at the companies with whom they're trusting their capital and paying less attention to central banks. I think we've talked way too much about central banks when we pretty much know what they're up to and what some of the effects are likely to be.
Now, turning to you, Russell, what impact will the end of QE have on interest rates in the US and other countries?
Well, I think it'll be a negative impact. I think it's already working out that way. We've seen some indicators rolling over that it would be a strong dollar, inflation expected, the tips markets inflation implied in America has rolled over, and commodity prices are coming down. That, I think, is auguring a move towards deflation. And if we look at the relationship between tips implied inflation and emerging market equities, it's been very tight now for 4 years. And when we look at a world of lower inflation and a stronger dollar, that's a world of lower emerging market equities and lower Asian equity prices.
And what is your view then? Will any asset classes benefit at all in this scenario? How will bond do versus equities? I'm asking you this question because several years ago, before the rally started in equities, you were quite bullish on equities. So it'd be interesting to see what you have to say this time.
Well, it's a very strange world we live in when you can recommend bonds at these yields, but bonds at these yields will probably outperform equities. We've had 5.5 years of quantitative easing, which has clearly been to the benefit of equity markets. But that has not yet solved the problem, and the problem is a lack of inflation. So if after 5.5 years of quantitative easing the market were to conclude that this was insufficient to take us to a world of inflation, bonds could have another significant and major rally. Personally, I prefer the bonds of countries that don't have a lot of government debt, the few of them that exist, such as Singapore and Norway, but I'd have to concede that even major countries such as the United Kingdom and the United States would do significantly well if actually we get deflation after 5 years of the central bank's attempts to abolish deflation.
Jerry, back to you. Do you agree with Russell that US bonds will outperform US equities?
Well, I don't think they will, and I would question that they have. Even through this calendar year, bonds, meaning treasuries, have underperformed equities. Equities haven't been as brilliant as they were a year ago, but they're mid-single digits. You've had really a coupon return in treasuries. I mean, there were some higher interest rates that were a good buying opportunity. So the only way in which I would see treasuries outperforming equities in the U.S. would be a severe U.S. slowdown that reduced inflation expectations and, more importantly, reduced growth expectations. I don't think that's going to happen, so I would disagree that that bonds would outperform equities, treasuries would outperform equities. I would expect equities to continue to outperform bonds through the remainder of this business cycle, which, as I said before, I think has at least a year or more to run. I think we're really talking about the next U.S. recession. I think that is somewhat later in this decade. That's when bonds would outperform equities. I don't see that in the immediate horizon.
Now, as you know, Jerry, there's a real fear of deflation globally, especially in Europe. What did it mean for markets?
Well, if we really realize deflation, obviously that's bad for real economies. It's bad for people's standard of living, and it's bad for financial markets. I think Europe feels some threat of deflation. The European Central Bank has told us they will do what they have to do to do what they are able to do to combat deflation. How effective it will be, we need to see. I mean, Japan appears that it might have eked its way out of the deflationary cycle, but I think it's worth worrying about. Obviously, there are some countries, again, we come back to India, that's had more of a problem with inflation than deflation. That seems to be easing in India. Lower food prices, lower energy prices will help with that. I think the U.S. is beyond its deflationary threat and is in a kind of good ground of price stability around the 2% target. So it's a varied answer around the world. It is something the Europeans need to be worried about.
I get your point, but are you in the camp that rates in the US will rise due to growth or remain low given deflation risk?
Well, what's low is a question of perspective. When I started in this industry 30-some years ago, U.S. interest rates were well into the double digits. So, low is a relative point. I think that the U.S. 10-year is in the 240 to 250 range right now. I would expect over the next year it creeps over 3%. That says that interest rates will likely be higher, but I would consider, let's pick an arbitrary number, 3.25 on 10-year U.S. Treasuries is low from a historical point of view. And I don't think it goes much beyond that because I don't think the U.S. economy can stand a long-term interest rate beyond that, call it 3.25, maybe 3.5, depending on the pace of growth kind of level. So the answer is, I think they'll stay low, but I think they'll go a little higher than they are right now.
Following up on that, Jerry, I wanted to know more about U.S. growth before we turn to emerging markets. You have stated that private investment is rebounding strongly in the U.S. So is the U.S. a really good spot of growth?
One of the things that I think keeps this business cycle going for a while is that there's considerable diversity around the world in which economies are strengthening and which ones are not. So that you have to argue that the U.S., it's fortunate for the world that the world's largest economy is doing well. The U.K. looks like it's coming out of what was a deep recession. And I think the interesting thing, and I think what investors really need to watch over the next couple of years is as attention comes back to the emerging markets, where there's been some disappointment in the last couple of years, I believe that that's where the next expansion, that many of these important emerging market economies, particularly in East and South Asia, are in recovery and beginning to move to an expansion phase. So we're out of sync around the world. And actually, that probably keeps the world economy from overheating and running into the excesses and bottlenecks that bring business cycles to an end. So the U.S. isn't the only positive story in the world. It might be the leading one right now, but where I'd be paying attention are the major emerging economies and their ability to begin to accelerate growth.
Well, we have an interesting discussion underway here. Russell Napier is almost certain that once the Fed stops the stimulus, global equities will head for a sharp fall, as there will be lack of liquidity to support the current valuations. But Jerry Webman believes that the U.S. economy is on a strong footing and there is no reason to be overly pessimistic. We will take this discussion forward after the short break. Stay tuned. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. How will different asset classes react to the end of quantitative easing in the US? Let's take the debate forward with our two guests, Russell Napier, the consulting strategist CLSA, and Jerry Webman, chief economist, Oppenheimer Funds. Starting with you again, Russell. As we enter the era of a US without QE, how do you think emerging markets respond as compared to developed markets?
Well, in a world, this is not just on the issue of the withdrawal of QE, but in a world where that continues, where the dollar goes up and we find EM having a difficult time, they've really got two options. They can either devalue or they can deflate. In other words, they can run a tighter monetary policy, hoping to make themselves more competitive at this higher level of the United States dollar. Most of Asia, I think, has the option to devalue, and in the taper tantrum of last year, we saw that they could take that option. Many people saw that as a negative, and I saw it as a positive, that you could have that flexibility. The markets, I fear, that have the inability to let the currency come down because it would cause severe problems of solvency for major corporates, and particularly banks, are all in Eastern Europe, in Turkey, in South Africa. So in terms of where is the most damage going to be done from the end of the quantitative easing, the rising dollar, changing inflationary expectations, commodity producing emerging markets and Eastern Europe rather than Asia. But in Asia we should expect lower exchange rates.
So Russell, does gold become less or more important? What about other commodities?
Well, what I've talked about so far is deflation. Now, in a world of nominal rates close to zero, deflation means higher real rates of interest. And really, since we've had a free market in gold since the early 1970s, that's been bad for gold. So the straightforward answer would be this would be bad for gold. However, and it's a very major however, governments are unlikely to let deflation take hold. They're likely to come up with policies to stop it. We all believe, or the markets seem to believe, that that will be just central banking. My belief is it will be much more aggressive action by the government in a regulatory role and in a fiscal role, and interference with the marketplace, and perhaps even in some jurisdictions exchange controls. Now, as soon as you get the governments more active in moving capital and moving credit, then the gold price starts to go up. So when you have two competing forces for a financial asset, you have to watch how it trades. And the time will come when gold will start to trade up on bad news. That's not where it is today. It's going down with a stronger dollar. It's going down with lower inflation expectations. So gold we have to watch, see how it trades. And when it trades up on bad news, it'll be in a prolonged bull market.
And following up on that, what about the currency markets? Does the US dollar remain a safe haven still?
Yes, it's rather ironic given that the great financial crisis began in the United States of America. No one ever thought we'd use the word safe haven in relation to the dollar again, but I think that's exactly what's going to happen. One can see that the Bank of Japan has to be aggressive in reflating. One can see that the European Central Banking has an awful lot more to do. But the Fed has probably finished with, at least for the meantime, with its more aggressive monetary policy. This means a strong dollar, and to some extent, in a time of geopolitical turmoil, also benefiting from safe haven status.
Now, Russell's view is that a strong dollar is not good for EMs. What is your view, Jerry?
So a strong dollar has a couple of effects on emerging markets. To the extent that they are importers of raw materials, energy and commodities, and exporters of manufactured goods, a strong dollar is actually beneficial. It holds down the cost of commodities, and it makes the manufactured goods and services, for that matter, more attractive to American consumers and businesses. So on the other hand, if you're an emerging market that's dependent on commodity exports, a strong dollar is not helpful because the strong dollar will hold down the price of commodities. So we need to differentiate between commodity exporters and commodity importers, and the strong dollar will have quite different effects on those two categories of economies.
So Jerry, you disagree with Russell. You are positive on EMs.
I think there will be great opportunities in emerging markets over the next couple of years. I think that turn is occurring. Some of the major emerging markets, particularly the ones with a manufacturing aspect, so India, China, Taiwan, Korea, we see an improving economic trajectory there, helped by a strong dollar and helped by stable to weakening commodity prices. There are other emerging economies that I'm more concerned about, particularly the ones that are dependent on energy exports.
And Jerry, following up to Russell's view on currencies, what is your view on the dollar? Does it stay stronger over the next 1 year?
I do think that in the medium term, so the next, call it year or so, the dollar should be one of the stronger currencies in the world. We're in Oppenheimer Fund's multi-currency portfolios, we have a stronger dollar position than almost any time I can remember in the nearly 20 years I've been here, on that view that as U.S. rates creep up, the dollar will strengthen. But of course, a dollar strengthening will have the effect of some tightening on the economy. That will slow the rate at which interest rates do go up, because it is a form of financial tightening. And that means the dollars, I don't think, is going to get to crazy heights. And there are some emerging currencies that we still have a relative weight in, because we think, usually these are stories about reforms, strong central banks and the like. India is one of the examples where we actually have a positive view on the currency.
And Jerry, if that is your view, wouldn't that be negative for gold and commodities?
Yes, I think that gold and commodities are not great appreciation opportunities over the next few years through this cycle. Let me make a point that I would make more generally about gold and commodities, just to show you where kind of theoretically or philosophically I start when I think about those. I see those positions as hedges in portfolios, not as appreciation or capital growth opportunities in general. You own them because of unpleasant, call them macro or geopolitical or inflationary surprises. They're positions that people hold so that they can hold other securities that have more opportunity for growth, such as stocks and bonds. So I'm not a big advocate of core positions in those kind of hard assets anyway. I believe that they're there for hedges, and the things they hedge against, particularly inflation, which commodities hedge against, I'm not terribly concerned about in the near future, so I'd be at a lower weight on that hedge than typically I would be.
Russell, now let's take the discussion back to you. What is your view on other asset classes that may come in favor during this period?
Cash is the least loved asset class. It's the one asset class that everybody loves to hate, particularly for institutional investors. So institutional investors for the last 4 years have been badly beaten up if they own cash. So clearly in a deflation, cash is something which goes up in value. It has that optionality when you can buy assets with it at cheaper prices. So I think the least loved asset class is cash, and it's time to have cash.
And Jerry, what is your view? Any other asset classes which will do well?
Well, depends on how you want to think about asset classes. I think this is still in a good environment for equities. I think the underappreciated part of those equities are the ones that are broadly grouped in the emerging markets. I think that's probably going to see the best returns over the next several years, even though they've disappointed recently. And of course, that means valuations are more attractive in some of the emerging markets. So I think that's probably where people need to be looking. If you're looking at income generating assets, I would prefer to see investors take more credit risk and less interest rate risk as they look for to the income generating portions of their portfolio. So that means lower rated bonds rather than longer maturity, high quality bonds.
Russell, how would you allocate over the next 3 to 5 years?
The next 3 to 5 years is waiting for a chance to buy equities when they're cheap. It is probable that they'll be cheap within that time frame. It's very difficult to say for sure. It's best just to wait. And for anybody who's looking for a guide to what's a cheap equity and what isn't a cheap equity, I think the cyclically adjusted PE is still a good guide. So we wait because equities are the asset class of choice for any long-term investor. Their long-term returns are superior. But at the current valuations, you're not going to get good long-term returns. So we're waiting for equities. And I suspect, particularly if people lose faith in the omnipotence of the central bankers, they'd actually become cheap relatively quickly. Because so much in the equity valuation is just based on the success of central bankers, for which I think there is very limited evidence.
Jerry, I'm sure you will have a different view based on what you've said so far. So how would you allocate across assets over the next 3 to 5 years?
Over 3 to 5, yes. So over 3 to 5 years, my allocation would be a globally diversified equity portfolio with a current overweight in emerging markets. If I need to be in the U.S., I'm not staying away from large caps, but I'm emphasizing small caps. And I would own some of the more credit-sensitive bonds in the stronger economies, principally in the United States. And by the way, I would maintain a position with some cash and some high-quality bonds because, like every other human being, I could be wrong about this. So I would be having reduced allocation, but some allocation to treasuries and cash in case, again, my expectations of decent levels of growth and low inflation, if for some reason I turn out to be wrong, I always want to have something to help myself in that if my foresight is not perfect.
So Jerry, you don't agree with Russell that cash is king? What role will cash play in your portfolio?
There are about $10 trillion in money market and bank deposit accounts in the United States. So there are obviously a lot of, among U.S. households. So there are obviously a lot of people who agree with him. I disagree. But I think one of the things that makes me optimistic is that there are still people out there who are highly skeptical about the markets and who are holding a lot of cash on the sidelines. I think as the U.S. economy does okay but not great, that cash is going to be continually pulled into U.S. equity markets, and that should support those markets over the next many months to come. So I'm pleased to hear that there are well-informed, thoughtful investors who are still holding a lot of cash, because I think that the market will induce them to put that cash to work in the months to come.
So that was Jerry Webman, who believes that equities around the world cannot be painted with the same brush. In fact, I agree with that. Yes, a stronger dollar and lower inflation will hurt the US economy. But oil importing countries like India will benefit from this. And we are already seeing that. Russell admits that the dollar and US Treasuries will remain the safe havens in the uncertain times to come. I believe the impending correction will allow attractive entry points for long-term investors. But for the time being, cash is king. Thank you for joining us. Come back next week for more global insights with me, Punita Kumar Sinha.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.